Good. We good. We can do this thing. What do we got? Just this one little graphic up there? You got nothing there. Hey, welcome to the closing beat, everybody. Happy Monday. How we doing? Ooh, that's zoomed in. You know, zoom it out. Now, hope you had a good weekend, everybody. Thanks for joining us here. We are financial advisors here at Jazz Wealth. Nice and close up today. We're going to talk about the stock market here today, and I'm going to bounce around a little bit. Just a fair warning, I didn't have a chance to put things in sort of the order that I would want to talk about them, but lots of good little things along the way. Of course, our wine and wealth last week, we went a little geeky there. We were talking about the midterms coming up. We talked about specific earnings plays, how you could focus on those. We talked about using options for those and specifically how you'd go about doing that. So if you're new to joining us here at Jazz Ed, maybe that one was a little advanced. This week, we actually may be on location somewhere, and we haven't decided yet, but we'll try to wrap our heads around that. So maybe a unique kind of a wine and wealth here with both me and Eric, actually. Fin tips this week, those are free. Those are on the YouTube channel if you want to check those out. They are... Well, I'm talking some of the geeky stuff, and Eric actually posted a video today on retirement for women, right? Different way to look at it there. Not everybody is, I mean, our dominant audience is male. I think it's like 87% male. But sometimes you got to, have brought up because of some clients of ours that were single women just planning, and you got a different approach there. Or what if you're planning for your husband? So he's got some cool things to look at there for you. That's about it. Let's go on over to the market. Somehow. Y'all with me? Hey, welcome, Doc, Marcus, Chris, Kevin. Hey, Kevin. Cool. Let's take a look at what's going on. Inflation continues to be the concern. Now, inflation's more the forward sort of focus, right? Day to day, we're looking at earnings, right? Because, we're in earnings season. But going forward, we're kind of focused on inflation, how the Fed's going to handle that, how it's going and everything. Remember that the problem of inflation is our problem. Until we scale back, the Fed raise rates all they want, but until we stop spending money, that's what's going to happen. Looking at the markets, as you can see now on the charts there, a lot of back and forth. October volatility is definitely there. I pointed that out in our notes from Jazz email over the weekend there. And so this is to be expected and to be continued to be expected, actually, because of earnings, number one. A big bulk of names are going to report next week. We've got over 60 names reporting this week. So it's going to be active. So once we get through that, we'll get back into the volatility there. As far as the S&P goes, which is what you see on the screen, a great reversal day. It was really important that the S&P closed near highs today, right? And you can probably guess why. You imagine if we started off, we're down just a touch there, and we start off going positive, and then we faded away through lunch. People that are wanting to throw in the towel, they'd have done it, right? We could have easily finished off of lows. So that's impressive to me, how we finished off of the lows. Remember, the downtrend here easily broken and very quickly determined if we do break that. So maybe we'll find out in the next couple of days if the earnings keep up. As far as earnings go, the banks take control of everything Friday, today, and a little bit tomorrow. You got JP Morgan, Citigroup, Wells Fargo, Morgan Stanley, Bank of America being the standout there. Solid. We don't have to go through each one of them and try to go over it. The bottom line is loan originations are down. A little bit less profit and wealth management divisions, but everything else more than made up for that. Net interest income, if you're curious what that means, that's the spread between what they borrow for and what they lend for. All of that offset any declines in any of these businesses. So doing great there. No real problems. I want to point out real quick, United Healthcare, which, by the way, is the 7th largest stock by market cap, if you didn't know that. Usually people don't think of that one there, but they are there. Did really well. Earnings great there. Optum Health now accounts for 7% of their total earnings there, so they did good. And you don't need me to remind you about Pepsi. Killed it on earnings. One of the best earnings reports they've had in over a decade there. And so you look at the S&P, and we're really at an interesting point. I spent the weekend kind of, doing the Notes from Jazz email and kind of thinking this through. What a really interesting point here. And I could tell from our clients, right? So we're grateful to have a lot of clients here at Jazz Wealth. Very happy you guys joined us. But I can always get a feel for, is there some like phone scam going around? Is there some catastrophe in some other state or something? Are people feeling edgy? Are they feeling a little happy, greedy, overexcited, things like that? And basically, you look at this, we're looking at the market going, I see the discount and I want to get a good price. I'm optimistic about getting a good price here in the short term, but I'm still pessimistic in the long term. That's the general feel from what I get from everybody is the world is in trouble and oh my gosh, the decisions we're making today are going to hurt down the road. But in the meantime, I like this discount, right? That's the general vibe if you're curious, right? So I've often thought about doing an extra video. I'm working on a home office to get set up, but I've often thought about doing a video. It's like, what are we hearing from clients, right? Like just like as a good data set. We're like, what are we hearing? Are they happy? Are they scared? Are they, feeling the pain of inflation? What's going on? Because it is a good data set. And I like myself some good data there. Now, like I said, I'm going to bounce around a little bit. In our Notes from Jazz email, which by the way, why can't anybody sign up for that? Can anybody sign up for the Notes for Jazz? Right, but do we have like on our site, can someone just say, I just want the weekly email. I don't care what you guys do. Is that, All right, we're going to ask Charlie about that because I think there's a way to do that. If there is, you're welcome to join, but if not, we'll look into that for you. Because I went through, this is what it looks like. It's a little jumbled up at the moment. I'll try to make it a little bit better for you. In the portal, you could see previous archived, points there, but I took a different approach, and I took the approach from the old Satchmo. Anybody know who Satchmo is? Satch. I said, well, he's got a great song. What a wonderful world. And I said, well, let me take a look at the other things that I see. From that song, he says, I see, and he sings a song, right? I can't quite do the voice. So I'm like, I want to show you all the things that I see not happening, right? Because the market's essentially pricing in 2008, right? I've shown that in numerous different ways here. So anyways, I took a look around. I started pointing out things that I see that are not happening to make this a horrible thing to be afraid of there. And so I was trying to find good reasons why we could be, getting into market, getting adjusted, getting things done there. One good thing here that I'll share with you, maybe I can blow this up in some fancy way. Go like that, maybe, so you can see the chart there. 36% of all Fridays this year, down 1% or more. I wouldn't have known that until I did this. 36.5% of all Fridays down 1% or more. Isn't that crazy? That's a record, by the way. 2008, 2009, some of these tough years, if you're, the most recent really tough years there, 28%. So hands down, Friday's been the worst day of the year so far. But losing more than 1%, 36.5% of the time, that's not a forward-looking data point there. That's actual. That's how things are going right now. My goodness, man. I thought that was crazy. Anyways, told you I was going to bounce around a little bit there. I'm going to just bounce a little bit off top. There was a lot going on. We could talk about the general market, and we will, of course, but we know it's an election cycle. I'm just trying to find good things here, right? So I said, well, let's look the data. Let's take the average performance of every day, right? So then we could show like a composite chart each year, like how would it do average. And then let's segment that through presidential cycles. Let me just show you. So here's what we've got on the screen here. So this is in year one of a presidential cycle, irrelevant of what calendar year it is. This is year one, average performance of day number one of the president taking over, second day, third day, all over, right? Here's year two, year three, year four, right? So this is the average performance in every single year during an election cycle. The red dot, that's exactly where we're at right now, right? There's another positive thing there. We're getting to the end of what is the worst month or year for presidential cycles. We're getting into that home stretch there. So we've got all these good things going. Best 90-day period in the market ever there. We got presidential election cycle going on there. I'm going to bounce around, show one more quick thing here. We also have sentiment at an absolute historical low, which, by the way, lesson of the day, this is for Carrie out there. Carrie was asking about this earlier. Lesson of the day. Consumer sentiment is a contrarian indicator, but only when it's bearish, right? So you can run the data any way you want. If you didn't know, consumer sentiment, the University of Michigan puts this out. It's a survey that they do. It's the longest standing survey that they do. And they're gauging sentiment. Well, we right now are more bearish almost than we've ever been. We actually were just more bearish than we've ever been. This chart's going to scare you a little bit. Hang with me. So in black, we have consumer sentiment, meaning from the bearish side. The higher the black line, the more bearish people are. This was more fun than me just showing you the consumer sentiment numbers and going, just take it for what it is. The lower the black line, the less bearish. Doesn't mean we're bullish. The less bearish we are. So for example, right here, over here, sorry. Looks like about, 2014 was, in this time period, the least bearish that we've been. We are over here. We just came off being the most bearish we've ever been. That is historically a contrarian indicator. And to do that, to illustrate it, I looked at every time the bearish sentiment hit a new high. That's the last time right there. What happened? That was absolutely at the bottom. I can't fudge that number. They're absolutely at the bottom. Let's go over here. This is where it had previously made a new high, right? You got to pretend this data didn't exist yet. So new high, where was that? The exact bottom. I'm pointing like you can see me. Where was this right here when we hit a new high? Now this, granted, the market was doing probably just okay there, right? The exact bottom, right? Where were we over here? Oh, okay, not the exact bottom, right? So look at how contrarian that actually is. When we're most bearish, we want to be in the stock market, right? Or at least thinking about it, right? Most bearish now, market's falling apart. So there's another thing. So I'm just trying to add things to it to go, before I had nothing. We've done months and months of these daily videos, and I had nothing. No way to tell you that this was a good time to buy the market. Just quietly sitting here going, I got nothing. I don't know what to tell you. So now that's changing a little bit, and I wanted to show that to Carrie because I told him I would there. And so that is that's your lesson of the day, by the way. Also, random, going to throw this one out to you. A little more advanced way to show this, but you guys can handle it. I'm comparing the small cap 600 relative PE ratio to the S&P 500. In other words, all we're doing here is saying, if this line is low or falling, the small cap 600 is trading cheaper than the S&P 500, right? If the line is trending higher, then the small cap 600 is trading more expensive than the S&P 500. So right now, we're 30% cheaper than the S&P 500. In other words, it's a valuation buy, right? It's a discount from a valuation standpoint. But I'll add to that, what's the best performing index of all time? Annualized, right? So if you're saying, I got to pick an index and I got to get in it. What is it? Every one of you would say the S&P 500. I'd just take that back. If you're a client, you'd say the right answer. Every one of you would say the S&P 500. It's not actually the S&P 500. Like when they say invest in the S&P 500 because there's no way you can do better, there's another index that does better. But I don't know why we're sort of trained towards that. Anyways, just wanted to show that is super, super, super discounted on a fundamental basis in the near term, really. All right, I rambled. Let's get back to the charts here. S&P up 100 points on the day. NASDAQ, obviously a very good day today. Very important, again, that this closed at highs. That will be the differentiator between today and any other day that we've attempted to put in a bottom there. People will start talking if they're not already talking on the interwebs and all that stuff. You got the Dow moving higher as well. Of course, a very good day for that one. One thing I want to point out, bonds. There's the 30-year. We'll work with this. All right. Do you know Tina? Cody? In the market terminology, Tina? Tina's a tough woman. Do you know Tara? Tara's nice. So in stock market talk, there's something referred to as Tina and Tara, and often they are referred to as females with personalities when that could be further from the truth. Tina just stands for there is no alternative. So that's a very probably challenging way to say that in today's sensitive environment. But you used to say, well, Tina's got me locked down. There's nothing I can do. Tina's got me in a cage, or I'm in the doghouse or whatever, meaning there is no alternative. Tina is the one. And I say that, and I'm going to reference stocks or the bond market or investing overseas versus in the U.S. Right now, or what had happened, Will Smith. What happened was people didn't invest in bonds because of Tina. There is no alternative. You get what I'm doing here, right? Because there's no money to be made over there. You can't invest because of Tina. Well, now we're switching to Tara. So you may start to hear that here and there from the old timers out there that are going to say, there are reasonable alternatives. Tara is your reasonable alternative, right? So Tina had you locked down and you're like, no, I can't take it anymore. Tara is now my girl. And there's various jokes for that and stuff, all very, fine and nothing wrong with it. But meaning you got bonds yielding like over 4%, short-term bonds, by the way, because remember, we're inverted. So let's highlight this. You go from having no other choice but to be invested in the stock market to being, well, I can put my cash in bonds. I'm going to try to do this. I'll get this fit a little bit better. Trying to make it so you can see everything there. All right. 4.5, 4.48, and 4.31. That's the 2-year Treasury rate at the moment. So you can get 4.48%. You can get, for 6 months, it's an annualized number, but you can get 4.3%. 1-year Treasury, 4.5%. Typically, these, the shorter the duration, the cheaper it is. But down here, you see the 20-year Treasury, 1.6, and 10-year Treasury, 1.5. Usually these are above this. That's why they say we're inverted. And that's a very simple thing because what they're doing, what's happening is the risk is more in the short term and less in the long term. Typically, the longer you loan somebody money, there's more risk that something happens to them and they choose not to pay you back. If you loan them money for 6 months, there's a reasonable expectation that you're going to get paid back in full. It should be no problem. You loan them money for 20 years, you go, well, not only am I missing out on potential growth, but there's inflation in there, and I don't know if you're going to pay me back. You charge them more, right? That's Bonds 101, just simplified so the kids can understand too, right? So now we've got Tara. There are reasonable alternatives. That's a new mindset. That's going to help the bond market. So when we look at the bond market and go, okay, I get it. There's a lot of Fed stuff happening right now. I may not want to be just diving in there just at the moment. But Tara, oh man, Tara is enticing the bond market, right? It's over here. This is an idea. I can get 4.5% or something like that. So look for that shift. That'll help bonds give a little bit of a boost there. And that's all I was really trying to say in my long-winded old age. But that's what's going on there. Real rates are now at least acceptable, right? They're getting attractive, but at least they're acceptable. And you have an alternative to putting up with your volatility in the stock market, right? So that's the one negative to the stock market, if I could just play devil's advocate today and say, well, if we get a bounce, you have people that say, Tara is calling my name. Tina had me locked in this whole time. I had to go for the ride. Tara's calling my name. Maybe that creates a little selling pressure. That'll be down the road. We'll focus on that for sure, I promise. And there you go. That's your talk for the day. And I teach you something? All right, Bank of America, of course. Anything financial you want to look at here today, fine, but I wanted to point out Bank of America. They were probably the best out of all of them in terms of all-around reporting. Highest net interest income there, highest earnings, lowest decline in earnings on asset management, things like that. So well done there, Bank of America. Wall Street Journal and everybody now says that Goldman Sachs is going to redevelop their business because of their consumer finance division. They can't keep up with Chase. Can't do it. Chase got there JP Morgan got there first. They're more dominant. They spend more. They're bringing in more. So Goldman Sachs says, well, what are we going to do with Marcus? We have loans out there, like $16 billion in loans and stuff. Tell you what, we're going to put it in essentially the RIA division, which is where we land, and we'll let them use that as a product there, which is awesome because I'm looking forward to it. So I welcome what they're doing there. Other stocks in the news here today, you got Meta. Apparently the metaverse, right, is not going so well. I read a couple articles on it over the weekend. I think it's a lot of wanting to poo-poo on something that is going to take a while to get done. I will tell you this, though. If you have thoughts on Meta or Facebook there, at the beginning of the year, their forward earnings were 6.6 times. Right? Yeah, 6.6 times forward earnings. Forward sales, sorry. Friday, 2.7, right? 66% discount relative to their 10-year average there. Okay, right? We're getting to a point where stocks valuations are now so enticing to fundamental investors that they're like, I got to do something. Maybe you don't believe in the metaverse, but like, it's so cheap, right? What if they give it up and go back to social media and buy all the platforms or something random like that? I don't know what they do, but just wanted to point that out. All right, you got Foxcore. Fox A is what we're going to look at here today. Rupert Murdoch is trying to find a way to get back with News Corp. And that's all restructuring. I don't know how that's all going to go. I didn't follow the breakup too much there, but if that becomes more, then we will, of course, keep you updated. Oh, I'm sorry. There you go. And Splunk. There's a private equity group. I believe it was Starboard. You are correct, Dustin. Starboard, 5% stake in the company for this one. You got a little bit of a pop out of that. 5.4% is an active stake in the company that they're looking at there. By the way, if you're curious, stocks that are trading cheap, and I'm not telling you to buy these, I'm just saying stocks that are trading at cheap valuations that are actually profitable. I won't look at stocks that aren't profitable and try to guess that that's going to be a good deal. Workday was trading at 11 times forward sales. Now it's trading at exactly half that. That's at the beginning of the year. So just at the beginning of the year, 11 times sales, now trading half that. TripAdvisor, also about half, was trading at 3 times, now trading at 1.8. Booking Holdings, these are some tough names. Let's go to PayPal. Where's PayPal at? 7.5 times forward earnings at the start of the year, now trading at 3.3. What else? Algen, we look at that one every now and then. 10.7 times forward earnings, now trading at 3.8. Salesforce, 7.9, now 4.3. Right? It's a 33% discount relative to their 10-year median sales. That's incredible. There's a lot of that. Ring Central, I don't think they have 10 years to go back, but 63%. And Alphabet was trading at 6 times forward sales, now trading at 4. 27% discount relative to their 10-year range. That's something to consider there, is it not? All right, I'll take your questions today and see if I can help you out with those. I'm sorry I rambled a little bit. Hopefully you learned something a little bit different. I get excited on the weekends, and I just start looking at everything, and then I'm like, oh, that's something interesting to point out. Hey, there's another one to point out. And I just keep going, and then that's why Mondays I'm all over the place, right? Yeah. Chris says, man, I could do better with a total market fund, but you do love your volatility. So the Tara approach is for all the retirees that had nowhere to put their money. Think of almost a decade that they had nowhere to put their money and get any meaningful amount of return for the level of risk that they can take. Now they have a choice, okay? Think of all the fund managers that said, Mr. and Mrs. Smith, you're 70 years old, 75, I can't take any risk, but I have nowhere to put your money, so I have to put some of it in the market. Well, now they don't have to do that. It takes a little pressure off the market. There you go. PayPal deserves a break. What's up? Did I miss is the data wrong? Something off on the chart on the side thing there? With bonds cheap, what are some of the ETF options? I assume different ones like stock sectors. Don't know where to start researching. Well, so I was talking about bonds. I wasn't talking about the sectors of the market. But if you're saying, I want to use a bond ETF, iShares has a ton of them, just so you can look at, maybe comparing the TLT to others. Maybe you don't want to be so long term. Yeah. Yeah. Oh, it doesn't update. Oh, sorry, I should have said that. The 10 and 20 year, where was I? With the rates that I was showing there, that's not up to the second. I should have been clear about that. Sorry about that. Yeah, anytime I show those weird charts with the grid lines in the background, I'm a day behind. So that's why you don't see me show like stock prices and stuff on that, because it'll always be off. Yeah, I usually use those just for making general kind of comments about that. Xanther's like, is there actually a good non-clickbait reason why this actually just hit the bottom? Did you not catch me there? Did you not catch me sharing all the different ideas? There's not going to be one reason, by the way. So that will never, anybody that says there's one reason, I don't know. I don't know what they're thinking. But what I'm trying to say is we now have many reasons to look at this and go, okay, that's a meaningful, worthwhile place in the market, right? To take a shot or assume it's a bottom, right? We've not had that. That has been, it's been a frustrating year. Okay, makes sense. So bonds are mainly long-term, short-term. I've heard of junk bonds and municipal bonds too. I don't know of any real liquid ETFs. Maybe that's not a concern for you. But I don't know many of those that focus only on municipal bonds. I'm sure there are. Probably check BlackRock. They were pretty big with them for a while. Corporate bonds and stuff. Usually those are just add-ins to slow down any other bond funds. But I don't know of any of those. Yep. I should be compensated. Oh, Twinkies are still back there? Yeah, we need a jazz sign, man. Well, let's eat the Twinkies first, and then we'll figure it out from there. All right, I'm going to wrap it up there. I did ramble a little bit more for you here today. I hope you learned something a little different. We should put the camera down here so I keep looking like down in here. Enjoy the rest of your day. We'll be back tomorrow to do this all over again. Appreciate you guys following, enjoying, and hopefully learning something. That's all I got. See you later.